For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Welcome to the show. Yes! Having some fun with my buddy. I'm Johnny Dean, your podcast host, Professor Plum. Hello, Rick Plum.
Hello.
Hello. Oh, we have fun off the air, don't we?
It's always fun to try to crack him up just before he hits the microphone button.
Right before the light goes on, he says something funny. And it's not that it's inside stuff that
it has nothing to do with our show.
Nah, nothing to do with our show. We can't be yammering, though, can we, Professor Plum? Or blabbering?
Blabbering on and on.
Is that what it is?
Yeah.
All right. Then I guess should we have to get right to the topic?
Sure. Let's do it.
Let's do it. Animal House reference already.
Yes.
That's good.
Yeah.
That's good. So this week's topic, it's interesting because a week or two ago, was it last week? I got to look. We revisited a topic from a year before that. It had to do with interest rates and bonds. That wasn't last week. It was a few episodes back. And the question was about bonds and interest rates and are fixed annuities, CD style better. We had done that topic when interest rates were very, very low a couple of years ago.
Right.
We did it again when interest rates were higher. Revisited that topic.
Recently.
A few weeks back. I've got another one that I want to bring up to you, Professor Plum. And if you looked at the title of the episode, you already know what it is.
I haven't.
Well, people listening have.
Oh, okay. Sorry.
So it has to do with the 4% rule.
The rule?
The guideline.
Yes, please. Let's get it straight from the beginning.
It's not
a guideline.
A rule.
But it's still a useful guideline. Does it mean that everybody should follow it exactly? No, but it's a great 30,000-foot level viewpoint.
It's a good starting point. Now, but we don't like to call it a rule because we violate this all the time. You. But you, as a certified financial planner professional, have seen this rule, guideline, whatever it is, for years. It's been around for more than 30 years. And I was looking at an article in the Wall Street Journal from, I think, November of 2023. And the headline was, "The 4% rule for retirement is back."
It's back? Where did it go? I know there were some outliers that said the 4% rule was dead, and that it should be like 3% or 2.8% or so. And I said, well, that's not a true way to look at it either. That's too literal of an interpretation of a non-rule.
Let's say it was out of favor. Kind of like shag carpeting or...
Well, that is out of favor. Avocado burnt, orange coloring in the house.
Okay. Explain, if you will, for people who are new, not new people, new listeners, who may not know what the 4% rule guideline is.
Well, and when it first came out, it was actually a little bit more than 4%. It was 4.5-ish. But it has to do with if you have a portfolio, if you're in your mid-60s and you have a portfolio of X, and you start by taking 4% of that X on an annualized basis, and you increase it by the CPI every year.
Inflation.
Yeah. And so, easy math, you had $1 million, 4% of that's 40,000. You start taking 40,000 out a year as a distribution, as an income to yourself to spend, and then increase it with CPI over time. You have like a 96% chance that portfolio will, assuming that portfolio is invested either 60-40, 50-50 in a balanced type of an approach, staying in, and rebalanced as we go along, staying in balance. You have like a 94-95% chance that portfolio will last 30 years until you're 95, which for most people is a satisfactory longevity in a portfolio. Now, some people will outlive that, but is that really a rule? Now, do you have to increase it with CPI every year? Is that the best strategy for doing it every year? And so some people say also, well, that's 4% of the initial value, but when years, so they tweak the 4% supposed rule and say, well, in years when the markets go down and your portfolio, look, you start with $1 million, you take 40,000 out, you're at 960, and then it grows back and you're back a little bit above it because the markets always do the same thing, right?
They do not. He's winking as he says that.
Being sarcastic. But what if the markets go down in that year and you're only at 900,000 because the portfolio went down 5 or 6% after you took 4% out? Do you then reset the 4% to the new $900,000 value
and take less
and only take 36,000 out the next year? Or what if you have a year like 2020 and 2021 where the portfolio went up by 30%? So at least the stock portion did. So maybe your portfolio went up 15 or 18%. Do you allow yourself a higher distribution? Because the 4% rule originally was fairly static in that it was 4% of the initial value plus CPI. They didn't adjust necessarily. But people say, well, we can adjust as we go along. You just have to either you allow yourself to spend more when the markets have done exceptionally well, but you have to be able to pare back when the markets don't do well. And so I don't necessarily like that idea, because what if the markets pare back when I don't want to, what if the markets go down when I don't want to pare back? I've already committed myself to seeing, going on these vacations, these trips, helping out with this, doing that. And I don't have the ability to pare back easily this year just because the market went down last year, which I have no control over when the markets go up or down. And so the 4% rule has been it's a starting point to look. Yes, when you're planning, especially younger, people that are not at retirement today, who are looking towards the future 10, 15 years away, who's not really even sure what they're going to need in retirement. Life is going to change a lot for that 45-year-old, 50-year-old before they get to 60, 65, and they decide what they're actually going to need to spend. How do you plan for something that you don't know what it's going to be? You can start planning on a 4%. You look at what you're doing with your 401k, you're saving, what's going on. You make assumptions about how much it's going to grow over the next 10, 15, 20 years. And then you say, well, at that point, I can say I've grown my portfolio to that proverbial $1 million, and I can have $40,000. My Social Security is projected to be X. My spouse's Social Security is projected to be Y. So if I've got X plus Y plus the 4%, that gives me an idea of what I could potentially spend at that time. And either that's, you look at it and say, oh, that is woefully short. Well, that means you need to save more. Or, wow, that looks like, that's looks like it's going to work really well. So now there's a lot of assumptions in there.
Yeah. So that is the 4% rule. Now you're saying initially it was that you take 4% of whatever the initial
value,
$1 million. You're going to take $40,000. You take the dollar amount, the same dollar amount each time,
right? Plus cost of living,
regardless of whether your portfolio was up or down.
Yes.
So if you had a really bad year and your $1 million went down to 960 because you took 40 out, and now it's at 800 because it just was.
That was a bad year in the stock market, but it could happen. But you still took out the 40 each year.
So now you're taking.
Well, and that's the way the original analysis was done. They used Monte Carlo simulations, and they strung together random 30-year periods.
Doesn't sound good to me.
And the whole idea is that if all you did was take 4% of the each successive year,
well, you'll never
run out.
Yeah.
And the fact that under the 4% rule, it did run out in certain scenarios. Very outlier areas, 3-4% of the time. It means that they were doing a very static, 4% plus inflation of the initial value.
So you don't like the 4%. I'm going to just call it a rule. You don't like that for many reasons.
Well, I don't like it because it doesn't take into account the individual's specific circumstances. It's not outrageously unusual, but it's not always normal that everybody has even a retiree has the same set of expenses every year, and inflation affects them exactly like CPI does. I mean, yes, a lot of people are carrying mortgages into retirement, but a lot of those mortgages will be paid off at some point during their life, and so their expenses are going to come down. Some people are delaying taking their Social Security until age 70 because it makes sense from either their longevity standpoint or their spouse's longevity standpoint. So they may need to take more money out in the early years, knowing that they're going to take less money out in the future years. So tailoring the distribution to your specific needs is a much better actual planning strategy. But as I mentioned earlier, from a 30,000-foot view, it's not the worst tool to play with.
Sure. Okay. So a good illustration of this, Professor Plum, is somebody who, let's say, has $1 million at age 65, and they're taking 40 grand. Let's say they take $40,000 out a year. And let's say they give themselves, 2% bump for inflation every year?
2 or 3, whatever the case.
Okay, let's say that.
Whatever it takes.
Now, I don't know if you have your calculator, but over 30 years, that $40,000, or call it 25 years, after 25 years, if you take $40,000 a year and you give yourself, call it a 2% raise every single year to cover whatever inflation you may encounter during that time, what about how much would you be taking out after 25 years, say, or 30, whatever?
Well,
Did I spring this on you before you had a chance to get your calculator out?
$66,000. 2% is not the worst case. But that's under, even though 2% sounds like a lot more than we had for a while, it's under historical norms. Typically, it's 3 to 4% is what we've seen as inflation. Now, the Fed is targeted, 2, but...
All right.
But let's say it's 3%. That's more like $84,000. So you've doubled your need from the portfolio 25 years later.
But you're 90 years old at this point.
Right.
And do you really does a 90-year-old really need double what they were taking at 65?
I don't like the word need there. Does the 95-year-old really want 95?
Are they spending that much at that point?
I don't have any white paper studies or any real studies that show this, but in doing this for the last 30 plus years, what I have witnessed is that as people age through their retirement years, when they get into their 80s and above, they tend to spend less money. Now, inflation will affect them. Inflation does make things more expensive.
And healthcare.
And healthcare. But unless you're a chronic user of healthcare, which, it happens, it doesn't all of a sudden come into, I'm 72 years old and I've got a $300,000 bill. They say the average retiree spends $300,000-$400,000 on healthcare over their lifetime. It's not usually in one lump sum in the earlier years of retirement. It may be spread out over the whole period of time, or it may be, unfortunately, towards the end of life. But the expenses are there. But what I have noticed is that as people get into their late 70s, 80s, and then beyond, their need for cash flow from their portfolio flattens out or can decrease and they just don't spend as much. I mean, we see married couples, and they're no longer going to the fine dining that they used to. They're finding that they split meals and they're full compared to ordering individually full
meals. They may
meals.
not be taking the vacations or the travel.
They're not traveling as much. The clothes that is in the back of the closet have come back in favor, so they're not shopping anymore.
No. Listen, you stopped buying new clothes at about somewhere in your late 60s, early 70s.
I don't know what it is that they're doing different, but they don't tend to. They're not saying, "Oh, hey, you need to increase my distribution this year because of inflation.
I'm going to run out of money."
Right, because in the early years of retirement, we hear that quite a bit. Hey, can you bump up that distribution a little bit because they're active, they're doing things.
All right.
So there's a difference. Inflation doesn't affect everybody the same way, or as CPI. I mean, I was doing some shopping the other night, and I looked at this pie from this local pie place up in the hills. Wonderful. I love these pies.
Yeah.
And I remember it was about 5 or 6 years ago. It sold. We could buy one at the local store for X amount of dollars. It's more than double X right now. I mean, I saw it at the store, and it was 2 times what it was just 5 years ago.
And people were buying it.
Yeah, as far as I know, I didn't see anybody grab one off the shelf at that moment.
If they weren't,
they wouldn't carry it.
The price would come down. Sure.
And it's like, well, let's see. To get something to double in 5 years, that's not 3% inflation. So, some things, but in my budget, it didn't affect my budget. Why? Because I didn't buy it.
Well, there you go.
I wanted to buy the pie, but I was like, all right, I'm not paying that for it.
When we get on the whole 4%, or what is a good, I hate to use the word safe because it's not necessarily safe, but you use the 4%
as an overall guideline.
As a guideline. Now, this is not to say that you can't take more in certain instances.
Let's go back to your 65-year-old with $1 million thing. Some people will look at it and say, well, I can't afford to live on $40,000. And so they say, well,
because they got $1 million, they have bigger expenses.
They've got more expensive than that. And, or they say, I'm going to live a long time. I want to wait until age 70 to get my Social Security. So either I'm forced to take it early or there's not enough. But they also forget that, yes, their mortgage is going to be paid off 10 years from now.
Maybe.
Whatever. Or they're going to take their Social Security 4 or 5 years from now. And so they have other things that are happening that'll change the dynamics of the plan. And so we're looking at, let's talk about what we're doing. Some other people, like I'll do a retirement plan for somebody and I'll project out 15 years or so. So I'm taking a 65-year-old to age 80, and they say, "What? Are you going to kill me at 80? Because you're not showing me what happens after 80?" No, I'm saying no. The variables that we're discussing here, your spending habits, the earnings, the taxes, and all those things, they have so much variability. Let's look and see, is this a viable plan? And one of the ways I determine whether it's a viable plan is to use all the projections we're doing and see where we are 15 years from now. Okay, now you're 80. You've probably got a pretty good idea of your expenses. What does the distribution rate look like at age 80 based on all these projections? And if we're out of money by 80, well, that wasn't a good distribution plan. But if you've got enough money at age 80 that you're only taking a 4 or 5 or 6% distribution at age 80 based on all the projections, this is a viable starting point. So we can use that 4% rule in multiple ways. One is to look at it today. Your Social Security has started. Your expenses are the expenses. Your mortgage is paid off, or you either got a mortgage paid off, or you've got a 30-year mortgage you're never going to pay off. So the expenses are fairly straightforward and fixed. Now, the mortgage is a nice little thing, though, because when we are talking about inflation, let's say that your mortgage is 25% of your budget right now. Well, that means that inflation, and you've got a fixed mortgage. Well, that means that inflation is not going to affect 25% of your budget.
No.
So if inflation is affecting, if inflation is 3%, you don't have to inflate the entire need by 3%, because part of that need is that mortgage payment that's fixed for the next 30 years. And so your inflation is not the assumed 3, or you can say it's going to be 4. And
inflation helps you with a mortgage.
And that,
really.
Yeah. So how do we look at these numbers? All of these are guesses. And so we have to look at how is this affecting us and whether that 4% rule. So anyway, back to the 65-year-old, they may need $70,000 a year for right now. And so from their $1 million portfolio.
That's a 7% distribution. That seems quite high, Professor.
And
Plum.
the success rate of a 7% distribution over a 30-year period of time
is not
good.
Yeah.
But we're not doing 7% for 30 years. We're doing 7% for the next 4 years, and then Social Security's kicking in and may drop that down to, right. my Social Security may be $50,000 a year, which means now I only need $20,000 from the portfolio, and my distribution rate at that point may be only 3%. Or then maybe a couple years later, something else expense-wise falls off. I've got somebody who is a pilot, a private pilot, and they say, I'm going to continue to do this until he's going to be 60, I think, until I'm 70. And then after 70, I'm selling the plane. I'm getting rid.
Good.
I'm not doing this anymore.
Yeah.
And so that part of his budget is going away. And so what is a 4 or 5% distribution right now, even with inflation, will drop down to a significantly lower distribution.
So you're saying
when that expense. So we have to understand what our expenses are.
Yeah. So you're saying that you can take upwards of 7, 8, maybe even more, depending on circumstances, for a few years, knowing that some of those expenses are going to be covered by they're going to be lower, or you're going to have more income coming in from Social Security, pension, whatever it is.
Well, let's talk about that 65-year-old with $500,000 in their retirement plan, and they need $40,000 a year right now from that retirement plan.
You're talking almost 10%,
right? But their Social Security is going to be $50,000 a year in 4 years,
which is high. I mean, certainly
not
the
for
married
a 70-year-old.
couple. Well, I suppose that's true.
I mean, now
married couple we're talking about.
No, I'm talking about an individual.
Oh, an individual.
Yeah,
50,000.
Yeah, it's getting up there now for somebody that's at a decent wage level.
All right, okay.
Now, actually, if they had a decent wage level, I'd hope they have more than $500,000.
That's what I'm saying. Yeah.
Okay, well, it's going to be $40,000.
Whatever.
At age 70, $40,000 is a very doable number for Social Security.
Uh-huh.
And so they spent their portfolio from $500,000 down to $100,000. But then once they turn on their Social Security, based on everything they're saying, they've got a 0% percent distribution need.
You know what jumps out at me about that example you just gave, Professor Plum, is that somebody who has a 70, what do we say? No, 90,000 a year need. What was that? No, $500,000
with a $40,000 or $50,000 need.
I'm sorry. Yeah. So they have a $500,000, let's call it a $40,000 a year need from their portfolio. They might have looked at this without hearing this and said, well, gosh, I need 40 grand a year. I only have $500,000 in my retirement account. This 4% rule
I need to work until that's $1 million.
That I've heard about. Exactly. They can say, I can't retire now at 65 because I'm taking 9% or whatever that number is, 9+%. So I will run out of money. But you're saying, no, you could do this. Right. You could take that high percentage out because you've got Social Security coming in.
So you got the $500,000 portfolio and you need $60,000 a year, and single individual, you don't have your Social Security. You have $500,000 portfolio. You need $60,000 a year.
Yeah.
You're 66 years old. You're full retirement age today. But you want to wait until 70 to take your Social Security because you really believe you're going to live to be 100. So should you live by the 4% rule and only take $20,000 a year out, scraping by until 70 when your $30,000, $40,000 of Social Security kicks in? Or should you take the $60,000 out now, which means over the next 4 years you're going to spend $240,000. You leave $260,000 in the portfolio, and then at age 70, your Social Security kicks in and you need $20,000 a year from your portfolio. Yeah, it's still way too tight. I think you should work another year, but it's not violating the 4% rule by all that much, because the 250, 260 will grow to 300, 340, by the time maybe it's 300,000 3 or 4 years from now. And he's still going to be able to take 10,000 a year from that, baby.
Now, if something like
12,000 a year,
going back to, let's say you needed $50,000 out of this $500,000 savings,
right,
retirement account. You're going to be taking this out for 3-4 years, maybe 5. I don't know.
Yeah. So you're going to do it for 5 years. You take $50,000 a year out of it.
You can't do it for much longer than that, though,
well, no. In 5 years, you've taken 250 out. You still have 250 growing for the next 5 years.
Well, hopefully you'll have a little more than that.
Right. But then Social Security kicks in at $50,000, $40,000 a year for 4 or 5 years from now. So you're getting $40,000 from that, and you've got $250,000, and all you need is $10,000 a year. Now you're back to the 4% rule.
What does this do for somebody who says, I've got 500 grand and I just took 50 grand out? It's down to 450.
Okay.
And next year it's going to be down to 400. I mean, what does that do to somebody psychologically when they look at this and they say, I am taking I'm watching my
and that's an issue.
Nest egg diminish by a lot.
But you also know that in 2 more years, you're going to stop taking money out of the portfolio.
Yes.
Because your Social Security is going to kick in. So now we've identified the issues, we've identified the solution. Now the question is, can you live with it? And there are times where people, this doesn't feel comfortable. Fine. If it doesn't feel comfortable, then we have to make a change. Either you work longer or you spend less money, or you take your Social Security right away. Those are your options.
Yeah.
Now we're not dealing with the numbers anymore. We're not dealing with the financial aspects. We're dealing with the emotional attitude. And those are both valid sides of the argument. I have to be able to make the numbers work. That's first and foremost. And I have to be able to accept emotionally what those numbers are telling me. Because even if the numbers are telling me, I know people who the trajectory on their portfolio, even after taking out more than they expect to take out, continues to go way up, but they're not comfortable. And so they keep working. Not because they really have to, because they've got more money than they're ever going to spend, at least on paper. At least, with everything, even if we cut down the rates of return and we go it just doesn't, I don't feel right with it yet. You have to deal with the emotional side too. And if that's the case, maybe work in a couple more years. That's your call. On the other side, I've met with people that said, you know what? Why are you working? Because you have enough to retire right now. And they're screaming for joy. Yeah. Because they didn't realize they had enough.
And I know people who are exactly spouses who are, one is of one is of the, hey, you know what?
We're good.
I don't mind watching it because we're going to be covered here at age 70. But the other one says, oh, it's coming down. Something bad could happen. So, I mean, I'm sure there's something out there that I don't even know about. And what am I going to do? I'm spending I'm spending chunks and chunks of this money down.
Right. And if emotionally that is a problem, then we have to find a way around that. But we do use the so-called 4% rule as a guideline, as a checksum at the 15 years from now to see where we're at on the distribution rates. Do matter. They do have an impact on what's going on. But it is not something that you have to rule your life around unless it's a distribution rate of that forevermore. If you're saying, yeah, I've got $1 million, but I need $120,000 a year from my portfolio, and I need it to last forever. Oh, and by the way, I want to leave something for the kids. It's like there's a disconnect here unless you're terminal. That sounds horrible, but
yeah, your solution would be to don't live more than about 4 years.
That's not a solution. Well, but that's not one I'm ever going to talk about.
Well,
but,
no, but
unfortunately, we have to. I think we start with the numbers, and the 4% rule can be used as a guideline, but it doesn't mean that it's a rule that we have to stick with. And going back to the original article, it's back now because for some reason it was gone. No, it wasn't gone. The way they interpret it is a balanced portfolio. And back 4 years ago, interest rates were very low, so the bonds weren't giving us any return and things. So they're saying if this continues indefinitely, we have to then potentially reduce the returns. But the reality was that wasn't true either because the stock market was doing better than what they were projecting. Now, this reminds me of back in the 90s, for those of us who are old enough to remember the 90s. And we had the new paradigm. The old rules of investing didn't matter.
Warren
valuations
Buffett was out.
Warren Buffett, old school. He's old. He doesn't know what the new economy, the .com, the new economy is where it's at. Those old rules of valuations of how to look at things, they're gone. They're dumb. They're old. He's just a dinosaur. Don't believe in him anymore. And then it all turned around. He became a genius again 4 years later. In 2002.
Part of the problem I see with people who say you got to adhere to this 4% rule because you could run out of money, because the markets could go down. They aren't even considering a bucket strategy at this point.
No, they're not.
And that is also, we don't have time to get into it, but you know where we always come from on this show.
Yeah, and a bucket strategy in all the situations that I've played with, worked with, historical returns, this, that, and the other thing, in every situation I've ever run, or I've taken a balanced portfolio and I've killed the balanced portfolio. Now, I can kill a bucket strategy portfolio too, but in every situation where I'm doing distributions like inflation, balanced versus a bucket strategy, the bucket strategy lasted longer.
In every case, you're saying?
The only case where the balanced strategy won was where I created a positive outcome for the next 20 years.
Only positive markets.
Positives. Never a negative. Never a downturn. No 2008s. No 2000 to 2002. No 2022. Yeah. No, none of those ever happen. And in that situation, a balanced portfolio kicks tail. It's wonderful. But if you have downturns in every situation where there were negative returns, it happens. The problem is we just don't know when. Yeah. The bucket strategy helped that distribution rate. So when I say the 4% rule, they talk about is it back? It never went away because properly strategizing your portfolio mitigates the effect of those downturns. What killed the distribution rates on those 4% rules? Early negative returns.
Sequence of return.
Sequence of return is what matters most when you're doing a systematic balanced portfolio withdrawal strategy. And if you have a positive systematic return for the next 15 years, you are golden. If you have,
no matter what you do,
if you have negatives in the first 10 years, and it doesn't take negative 10 years, it just takes a couple or a big one, and you're in trouble. You're going to have to then start making adjustments. You're going to have to start making those emotional issues of, oh my goodness, this just doesn't feel very good, so I'm going to cut back. I don't want to have to cut back based on some outside source that I have no control over.
Well, that's why when we look at things, that's really the main reason, Professor Plum, that you are saying that we never left the 4% rule. Because when you use a bucket strategy...
Well, we never left the 4% guideline.
When you use a bucket strategy,
yes,
you can still use 4% as your guideline.
Oh, yes.
I mean, regardless of what the market's doing.
Right. And you can look at, am I using 4% today? Or am I looking at 4% 15 years from now? What's my distribution rate 15 years from now? I can use 8% now, knowing I'm going to use less of it going forward. And it's about your personal investment, your personal journey in retirement. And it's very personal to you. It's very different than anybody else. That's why some of these rules, the take 100 minus your age, and that's how much you have in stocks.
Oh, please.
That assumes everybody has the same portfolio, the same income needs, and the same risk tolerance.
Oh, but it's so easy.
Oh, it's easy. Yeah.
Anybody can do it. This is...
Don't live up by rules of thumb. Work a strategy based on your needs, your desires, your feelings, and make it work for you.
This is brilliant stuff. I mean, this sounds logical. This is, if I may say this from my point of view, all this stuff that you've said over the last 30 minutes, brilliant. I mean, really. But this is how it works. You're not going to hear this anywhere else. You need Professor Plum or any of the Lucia Capital Group advisors talking to you about this stuff. I would strongly encourage you to give them a call, 800-644-1150. They've, of course, been our long time sponsor. I guess these 3 decades.
Yes.
And they can help you out. Give them a call, as I said, 800-644-1150, and they can talk about a bucket strategy with you if you know anybody that may benefit from that kind of stuff. Hey, tell them about this podcast. Tell them you just heard one of the most brilliant podcasts you're ever going to hear on this particular date, whatever date this happens to be that you're listening to it, and tell them to listen. You can go to Apple Podcasts, you can go to Spotify. You really should be subscribing because you don't want to miss any of this content. Get it downloaded to your device automatically, and get that done. Get that done because you're really going to get some wonderful stuff. Let's see. What else was I supposed to say? Is that it? Oh, I was going to say,
That's
you know
why
what
you're
I
the
didn't
host.
do? You know what I didn't do again?
What do you not do?
For the 5th straight time is give your other designation. I wrote it down, and I don't know what I did with it. You are a certified financial planner professional, CFPR with a circle around it.
Yes. Well, that's the designation, yes.
Yes.
And then I have the AWMA, Accredited Wealth Management Advisor.
I'm just going to have you say that every single time. That's what I hadn't done.
Yeah, it's just more initials. Just makes my card busier.
That's all it does.
For anybody that uses a business card still.
You can go online. Yeah, whatever happened to those? Go online at luciacap.com, LUCIACAP.com. Find the videos, and we got a bunch more. And if you folks have been wondering where the Lucia Capital Group weekly videos have been, if you've subscribed to those, you get them in your email inbox every single week. Those are going to be coming back here, and actually, they may be back by the time this episode airs. So
okay.
Be looking for that, I guess, in your email inbox. Oh, one more thing I wanted to mention too. This we have available for you, for everybody listening, the Bucket Strategy Guide. It's out. It's finally out. It took a little while to get this whole thing done, but man, is it detailed. You can download this particular guide. Talks all about the bucket strategy, and one of the cool things about it is it gives you right up front. It explains how it works in about 3 or 4 simple steps. If that's all you want, you just want to know how it works in a few simple steps, you can download this guide and take a look at it. Beyond that, it's got explanations. It really can get into the weeds for people who like the details of the bucket strategy and how it works through the Lucia Capital Group method of bucketizing people. You can download it. You go to our website, luciacap.com, LUCIACAP.com, and you'll see in the upper right-hand corner there a search bar. You type in Bucket Strategy, and the first thing that should come up is the Bucket Strategy Guide. You click on that. You can download it. As I said, it's free. Read it. Read it when you get a moment, and if you want to know all the details and more about how the bucket strategy is put together, get our guide. You really should. This is an invaluable resource, and I said it's absolutely free. So again, go to luciacap.com and click on the search bar, type in bucket strategy, and you'll see that guide available for you. So, Professor Plum, hey, listen, I thank you so much. As always, I appreciate that. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks for listening. We will, of course, talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read the insurance company materials carefully. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.